Well, good afternoon, everybody, and welcome to Australian Catholic Super's final webinar of 2021. This afternoon, we'll be talking all things retirement planning, and joining us this afternoon will be Phil Johnson, one of our financial planners, and I will refer to him throughout the presentation because it's always good to get that perspective from a planner who's dealing with our members on a one-to-one basis each and every week. And we've also got Justin Colley helping us with the chat box. So for those of you that do wish to ask a question, by all means, put it in the chat box, as I say. He'll answer it progressively as he can, but if there are any outstanding questions or anything we need to further explain at the end, I'll cycle back to Justin just to make sure we've covered off everyone's questions. This is also being recorded, I should just let everyone know, and will be available tomorrow on YouTube and is being broadcast live on Facebook. I would like to acknowledge the traditional custodians of the land on which I work and live and recognise their continuing connection to land, water and community. I pay respects to elders past, present and emerging. And I should say from the outset that today will be general information. We encourage anyone who does wish to do anything with their superannuation and impact their own circumstances to download the PDS and have a look at it and read it. And furthermore, we do encourage people to seek advice, particularly when they're making major decisions. And we will be talking this afternoon about those major decisions. I should also mention too, and I don't have a slide on it at the moment because the news is that current, that it was announced very recently that Australian Catholic Super has engaged in merger discussions with UniSuper, and there is a lot of information on the website about it, but there is currently a memorandum of understanding, there is due diligence going on, and we will presumably be moving to a heads of agreement. And if all things go as both parties expect, we would expect to be a merged entity by about this time next year. As I say, there's a lot of information on the website. We will keep the membership up to date as things progress, but you may have seen that news in the last week or so. So if you haven't, feel free to have a bit more of a look on the website. But today we're talking about retirement goals. And as you can see from this opening slide, retirement goals differ with everyone and change over time. And if we have a look at international travel, for example, and cruise ships, they perhaps aren't as appealing as they once were. And over the last 12, 18 months, a lot of this activity hasn't even been possible. So camping and gardening are probably the two things that have become more popular over recent times. But I will throw to Phil on this one because he's talking to people all the time about their current retirement goals. And if we can just tap into Phil's brain, we'll get a bit of an insight into what's concerning people at the moment and what they're aiming to do as they give work up. Phil, over to you.
Well, thanks very much, Wayne, and good evening, everybody. Yeah, that's right, Wayne. It's been a bit restrictive in terms of some of those, the travel and cruises and things, and I hope that improves. Certainly a lot of people over the years that I've been doing retirement planning, that's a big part of what they want to do. But people nevertheless, they're still planning on longer term, wanting to do those things, or obviously there's a lot of people these days want to do more domestic travel and things like that rather than international. A lot of people, me included, just waiting to see how things pan out. But the point I wanted to make anyway was that as financial planners, people, particularly when we're looking at people's retirement, we're obviously looking at the financial situation of members when we're starting to talk about these things, but they're all linked to your finances are linked to the rest of your life. All these things are things that most of them anyway, maybe not family time, but most of these things cost money. And and we're very interested to hear, as a starting point, to talk to people about what exactly their goals are, and to try to get a bit of a feel for how they link back into creating a financial plan for them.
Thank you, Phil. And just to help people with the obvious question, and this is a question that comes up time and time again, people will often ask, how much do I need to retire? Of course, it's going to differ for everybody, but the Australian Superannuation Fund Association have tried to put some numbers around it. And forgive the vagueness of this, because it's very, very difficult, obviously, when you're trying to capture how much someone needs, all the way between sort of Hobart to Cooktown to Broome to Perth and everything in between. It's nigh impossible. But if we treat this as indicative, I think it can be very, very useful. So what ASFA is saying is, for a modest income in retirement, a single, as you can see there, needs around 28,500, and a couple needs a bit over 41. And for a comfortable retirement, a single should be looking at around 45,000 and a couple around 63,500. Also, you'll note there on the left, if you qualify for full age pension, you can see the full age pension actually gets you a fair way towards that modest level. Now, out of this, the next obvious question is, well, what's modest versus comfortable? Because someone's comfort may be someone else's modesty, if you like. So if we talk about what comfortable means, ASFA do go some way to try and define this. And if you're interested in the detail, you can see down the bottom there, you can get the report, and it goes obviously into a lot more definitional explanation. But you can see there, a comfortable retirement, when we talk about owning a reasonable car or good clothes, they're pretty subjective terms. They mean different things to different people. So, and when we talk about bottled wine can be incredibly affordable. So it depends on whether it's quality bottled wine or perhaps not, if you like. So Phil, do you want to speak to this slide at all when you're explaining to people modest retirement goals versus comfortable, and using a guide like this?
Yeah, sure. I don't know whether people can read the detail on the slide, because I know it's quite small, but I mean, you can look at it on the website, as Wayne said, but I mean, there is some interesting comments about the subjectivity of it. I noticed that the age pensioners are home brewing rather than buying beer. So, yeah. Look, I would like to say this about the whole exercise. Yeah, you might be, people might define things differently, but I mean, I must have literally helped thousands of people with their retirement planning, and I reckon that, in my view, that those figures do definitely apply, or I would say, in my experience, would be relevant to a lot of the clients that I've seen over the years. I think, for instance, what was it? The figure for the couple was about $64,000 a year, wasn't it? Have I come across many clients in my time that would be living on that sort of retirement funding? Yes, for sure. I think one of the big points is that it does assume that you're debt free. So it's $63,000 debt free, and so yeah, I mean, I think that they are a useful guide. They're a starting point. As financial planners, we tend to take a more a personalised approach than just using the ASFA standards. We're interested in talking to each individual client or member about how much their comfortable lifestyle or their lifestyle they want to live and what they want to do. So we take a more tailored approach, but yes, for sure, this is useful. I think it's useful information as a good starting point for people.
And when we talk about retirement, we usually talk, when people are preparing for it, to take a holistic view of the assets you've got. So we're not just talking about your superannuation fund. It's obviously going to be a major plank for many, many people. but it won't be exclusive to superannuation. So for people like Phil, they'll be taking into account shares held directly, perhaps investment property assets, the family home, because potentially people may wish to downsize, and we'll talk about that as we go through the presentation. And they may also have reasonable holdings in cash. Phil, you would expect, I expect you would see quite a variety of assets people are holding and able to use for retirement purposes.
Oh yeah, absolutely. Obviously, a lot of the people I'm seeing, given that we are Australian Catholic Super, are going to talk to us about their super, and we want to talk to them about that. But quite often, it's not the only asset that they may be looking at to that potentially fund their retirement. It could be some of the common ones. Well, they're listed the common ones, but yeah, in particular, people quite often do have some money in the bank that, given low interest rates and things like this, if they have a bit of money tucked away, they might be looking to try to make that work a bit harder for them to help fund their retirement. Another one of interest, more and more interest these days, is downsizing. And using the family home to potentially help fund their retirement. Not usually done just to fund retirement. It's quite often done because people feel that they don't need a house the size of what they had, particularly when they had children. So it could be being done for practical purposes, or it could be for mobility. But nevertheless, if that's an area that is something in your life that you think you would be addressing, then yeah, we're going to take that we want to take that into consideration when we're looking at your plan.
The other thing too, when you're moving from super to that retirement phase, and you're typically moving from a superannuation account to what we call an account-based pension, the tax situation differs. So for those in superannuation, and for those even in a transitional arrangement, there is a 15% tax rate on the earnings. So to explain, imagine you've got $100,000 in super. The fund earns $10,000 for the year. 15% of the $10,000, $1,500 would be due in tax. So it's not a 15% rate that applies to the lump sum. It only applies to the earnings. And we do see a bit of confusion around that at times. Once you move into the account-based pension situation and you're in drawdown phase, however, the tax on the earnings is at zero. So there's a reasonable incentive to move towards the account-based pension when you're in retirement, because you won't be paying a 15% tax rate on the earnings that the fund generates. In terms of tax otherwise, there are three groups essentially when we move from what we call superannuation accumulation phase to pension phase. And you can see with these three circles. Phil, I might ask you to talk about this if I may, just because there's a few nuances, particularly around that 58, 59 category.
Yes. So look, the reason particularly for that 58 to 59 category on the slide is because people may potentially be able to access their super and retire at that age. Now, it depends on something called your preservation age, which is basically the age at which your government will let you access your super, and that age is slowly increasing. So different for different people, but from a tax perspective, accessing your super before 60 is potentially taxable. So whilst you may be able to access it at 58, 59, you may, if you do access it, you may pay tax. However, once you reach 60, and if you retire or access your super, then there'll be no tax on taking money out of the super at that age after age 60. There may still be restrictions on whether you can access the money. Once again, if you're 60 and you're still working, generally speaking, you won't be able to access your super, or not fully access it. However, when you get to 65, you will be able to access your super regardless of whether you've retired or not. And because you've already turned 60, you will be able to access the money and receive it tax-free.
The other strategy people will often talk about, and this is a very common barbecue conversation, is salary sacrifice. And just to explain what it is, it's essentially whereby you ask your employer to submit more money into super without having to pay income tax on the money. So it's going directly from payroll, if you like, to the super fund, and you're paying a 15% rate on it. But because it's going direct to the super fund and not to your bank account, you're not paying your marginal tax rate. So as you can see there is an obvious tax saving, and the saving is the difference between 15% and those marginal tax rates. So if you're in the bottom tier of 0 to 18,200, salary sacrificing may not make any sense at all because your marginal tax rate is 0. Whereas if you're on those higher brackets, it certainly does. If there's a downside, it's you're foregoing, if you like, current income for future consumption. So the thing to bear in mind is if you're putting it into super, as Phil mentioned, you'll be subjected to what we call release conditions. So if you're salary sacrificing, for example, at 25 years of age, you may not be able to get access to the money in all likelihood until you're over 60. So that's a huge consideration. But as you approach those ages and you approach those release conditions, if you like, and that those ages where you can access the money, this starts to make a lot more sense. Also, too, you're typically on a lot more income as you get older than as opposed to when you're younger. Phil, is there anything more to say on salary sacrifice, or is that pretty much?
No, I don't think so. I mean, I think that's right. I mean, I just think as well, particularly for younger people, I mean, if they're paying off loans and things like that, it's all got to be taken into consideration. Have you got the surplus cash flow? Because salary sacrifice, generally speaking, will mean that you may receive less take-home pay.
Thank you. Salary sacrifice is one of the what we call concessional contributions, or one of the pre-tax contributions. So when we talk about concessional contributions, we're talking about money coming from your employer, and that can be in the form of the superannuation guarantee, currently 10%, salary sacrifice, as we've just spoken about, additional contributions from the employer, or even personal contributions which you then claim a tax deduction for. Note the limit on those contributions in total is $27,500 this financial year, and you will be subjected to a 15% contributions tax on the way in. Why are you paying contributions tax? Because, as we just discussed, you're not paying your normal marginal tax rate. The ability to put in more than $27,500 at the moment does exist because you can use what's called unused concessional contribution caps of previous years if your fund is under $500,000. However, what I would say is please read the fact sheets on this just to make sure you fully understand it, because as I say, there's a couple of nuances to be able to use the previous proportions that were unused from financial years gone by, but it can be an excellent way to contribute more than $27,500, for example, this financial year, to boost your super in a tax concessional way, if you like. Again, Phil, you would see people who are doing this pretty regularly. Is there anything else to mention on that front?
No, I mean, small, well, not small points, but other little details are things like this scheme was introduced for contributions since 2018-19. So it's the accrued amount that you have available to you since that period of time.
Excellent, thanks, Phil. And when we talk about non-concessional, we're actually talking about what we call post-tax. So these are amounts of money that are in your bank account and you've paid income tax on the money. So naturally enough, because you've already paid tax on this money at your marginal tax rates, the limits are much higher in terms of how much you can put into superannuation. As you can see there, if you're under 67, you can be putting in up to $110,000 a year, and you can even use what we call a 3-year provision, which allows you to put in up to $330,000 in a single year. So when people say things like superannuation is a little bit restrictive on how much you can put in, it somewhat depends on your definition of restrictive. If between you and your spouse can, in ordinary years, put in $220,000 of after-tax income, and in one extraordinary year, $660,000, I would argue getting money into superannuation is not restrictive at all. But again, it depends on your perspective and how much after-tax money you've got available. When we talk about the next group, the 67 to 74-year age group, there's no work test that will apply. So currently what's been announced, and as far as I know, Phil, and correct me if I'm wrong, it's been announced, but the work test, it hasn't been legislated that the work test is gone from those aged 67 and above, but it is expected to be gone in the coming financial year. So announced in the budget, but yet to be legislated. Am I correct on that, Phil?
Yeah, that's correct, Wayne. Yep.
Good. And you know, for those over 75, there are no further contributions to be made. The idea being, at that age, it's time to be drawing down on your money, not contributing further. Other ways to contribute. Now, Phil mentioned this one earlier, the downsizer, a terrific strategy for those approaching retirement or those in their 60s, if you like, to play a bit of catch-up footy, if you like, to get money into a very tax-friendly environment. Spouse contributions as well. And obviously, all things being equal, we would encourage people to consolidate their super rather than have multiple accounts. So Phil, if I can ask you just to talk to downsizer and spouse contributions, if you would.
Yeah, sure. Yeah, so I mean, as Wayne said, you can actually put quite a lot of money into super as after-tax or post-tax contributions, as we've already talked about. But this downsizer contribution is in addition to those contributions, and so the government will basically let you make what's called a downsizer contribution into superannuation if you're over 65 years old, subject to a variety of rules, but the main ones being that basically you've owned the home, it's been your home for more than 10 years, and so you can do up to $300,000. That's each. So for a couple, like said before, Wayne, that's actually $600,000 that can go into super, in addition to whatever other money you could put in based on the other contribution types that we've already talked about. So yeah, and once again, I mean, yes, I mean, we're doing more and more downsizer contributions. It has been quite popular since it was introduced. I don't know, it feels like about 3 or 4 years ago now. Yeah, so that's been something of great interest, I think, to clients that are thinking of downsizing. Spouse contributions, yes, you can make a contribution to your spouse's account. The main benefit of it is that you may be able to receive a deduction in your tax liability as a result of making that type of contribution to your spouse's account.
Thank you. So the next question we get quite a bit of is, how can I access my super? Well, in two ways. Essentially, once you meet those release conditions, for example, let's say you're retired and you're over 60, you may want to take a lump sum out of your superannuation, or you may want to convert it to a pension and start taking an income. You can also do both. So for a lot of people, for example, they may choose to take a small lump sum to pay off a debt or purchase a new vehicle or whatever it may be, and then take an income stream that on best calculation and on best modelling will hopefully get you through your entire retirement. And this is where planning can play a huge role to ensure that it does. And when we talk about this move from super to the pension, again, we're talking about those contributions you can see on the left that make up your superannuation account. So it will be personal contributions that we've spoken of, employer contributions, any lump sums you may have received, government co-contributions, other super funds that have been rolled over, the downsizer contribution, which Phil just referred to, and those in their entirety will make up what your pension account balance starts at. So it's worth noting, when you move to the pension account, it's a bit of a one-way street. You'll be taking money out of it, but you will be unable to put additional money into it. So the pension account can certainly grow because of earnings, but it is unable to increase its value due to additional contributions, if you like. So that's one thing to bear in mind. So the upside of the pension account is obviously the earnings are tax-free. However, the downside is once you go to that pension account, you can't tip in additional monies. So just be aware of that before you make that move to pension. If you do happen to, for example, have an inheritance, when you're in the pension phase, it is possible to have the pension account move back to superannuation, consolidate the additional monies, and then move into a pension account again. So you can do that. So the system is pretty accommodating, but just be aware ordinarily once you've moved to pension account that you don't add money to it. And this is typically what we see people go through in terms of their various stages. So they work throughout their life, they contribute to super, both from the compulsory employer contributions, but also with those additional contributions that we spoke of. That super account grows and it becomes hopefully a substantial sum. You move into this pension phase where, as you can see there, it is able to be taken from age 60, but on some occasions even from under age 60. And the withdrawal amounts, as you can see there, vary in terms of their minimums depending on your age. So as you get older, the idea is the minimum you need to withdraw from your pension goes up, because the actuaries have worked it out that ideally these pensions should exhaust themselves if you live long enough. They are designed to do that. So if you're in pension phase and you're seeing a declining balance, if you like, that is exactly how they're meant to work. So they're not meant to carry over a huge lump sum that goes into the estate. They're actually meant to withdraw down and decline as you get closer and closer to life expectancy. And we will see an example of that shortly that I'll ask Phil to talk through, being a typical scenario of a pension couple. In terms of the offerings at Australian Catholic Super, when you're in the pension phase, there are two. So there's what we call RetireChoice, And retired choice, as the name implies, means you choose where the money's invested. So to be specific, you could choose any or all of these various funds. So you could choose the diversified funds on the left, which have a mix of the various asset sectors, or alternately, you may choose single sectors, as you can see on the right, or you may choose whatever configuration of the two that you wish. So it gives you complete choice and complete control on where your money's invested. For many people, however, they actually don't want to make that choice. So what there is what we call RetireSmart. So RetireSmart is where the fund actually invests on your behalf in what we would call a growth and defensive mix that's designed to statistically maximize your return while minimizing your volatility, if that makes sense. So it's a two-bucket strategy whereby the distributions go into cash and the pension payments come out of that cash account. And to illustrate that, the next slide probably does a better job than what I can with words. So if you see here, you can imagine you've got your pension account. It's providing these earnings, these cash distributions. That goes into a cash pool from which your pension payments are made. And if you have excessive cash distributions, and hopefully you do, then the excess cash actually goes back into the growth assets to generate even further distributions. Phil, is there anything further I should mention when it comes to RetireSmart and how that works mechanically?
No, I think you've done a good job there, Wayne. I think that yeah, it's just that the like you said, the fund is choosing how that growth. I use the word bucket. Growth bucket is invested. So the fund's making those choices for you. So depending on how you want to look at it, that can be for many people an advantage because the fund's making these decisions. On the other hand, it's not specifically tailored to you. Whereas RetireChoice gives the member much more choice, as the word suggests, about choosing what the appropriate level of balance between risk and return for the client. So they've both got their various merits. They're different products.
Thank you, Phil. And the obvious goal is to guard against what we very politely call longevity risk, which is what many current retirees and pre-retirees fear, and that is running out of money late in life in retirement. So understanding longevity risk and understanding how much you can draw down and still have sufficient is a very, very important key question, particularly for financial planners such as Phil, and that's a lot of their value, if you like, helping people through that process. Because inevitably people have this question of, do I have enough? And COVID has been a real wild card here. Normal expenditure patterns in retirement have been broken in many ways because of our inability to travel. We've spent a lot more locally and we've spent a lot more domestically, if you like. But overall, we've spent less. So the savings rate's been noticeably higher over the past 24 months. So this longevity question has in some ways been relieved, if you like, because over the last 24 months, we just haven't spent in the normal patterns that we had previously. For those that are really interested in trying to calculate this, we do have a calculator on the website that if you provide your details, it will help map out with a lot of assumptions, admittedly, but it will try and map out as best it can what sort of longevity risk you run, and do you have sufficient funds to provide the income you're requesting through to, again, life expectancy and perhaps beyond. Because again, we've got to work on average life expectancy. So you may be particularly healthy. So therefore, you will need to have money in reserve for that occasion. And hopefully that is you. Phil, when you're helping people with this longevity question, what are the factors you take into account?
Well, yeah, I mean, it comes right back to one of those initial slides that talked about your goals, and that's you go right back to the starting point. Well, what are you planning on doing in your retirement? Trying to work with clients to quantify what those sort of things might cost. What things do you want to do? How much might they cost? Is there windfalls or surpluses or inheritances and things like that? Building all those things into the equation to try to build up a complete financial picture of what's going on in this person's life. And then working with we try to work with the clients once again to try to and we talk about when you're investing the money, how much risk do you want to take with the money? What sort of returns are you trying to get? Trying to work out a level of comfort about how the money should be invested, because that has an implication for how long your money will last as well. So, we're trying to work with the clients to build up enough of a picture so that we can make reasonable assumptions about what might happen in the future with your investments and your costs and things like that. So that ultimately we use software to help us model the situation, and we take into account other things as well, like as we're going to talk about in a minute. Are you entitled to the age pension? How much might that be? How much might that change every year? All those sorts of things are all factored into calculations and modelling to try to work out exactly what it all means for a particular client.
And Phil, if I can just ask you to talk through this example, which is, I dare say you would see clients quite similar to this, whereby we've got a 65-year-old, you can see the super balances there. They do own their home. Phil, if you can just walk us through this, and I'll move to the next slide when you're ready.
Yeah, that's right. Well, so I've sort of started to talk about this a minute ago, that we were about to see the output of the projections that we do. And, here's just an example, like Wayne said, this particular couple, 65, they've $300,000, they're homeowners, which is important for Centrelink because they treat you differently whether you're a homeowner or not at Centrelink. And the age pension, these people need $63,000. Now, why have we chosen that figure? It happens to be about the ASFA standard, so I think it's it's pertinent for tonight's audience. Then we've built into that projection some assumptions around the rate of inflation, the return on the investments, yeah, I think we should look at the next slide. Yeah, so there's there must literally be thousands of calculations going on behind the scenes when we work all this stuff out, but we do end up with a graph. This particular graph, you can see that what it's trying to show you is that these people, 65 years old, they have about $600,000. So we're not including their home in this. So we're not telling people that you must fund your retirement through your home. So these people, it's through their super. And then it's just simply showing how long the money we expect in this particular model based on the assumption we made. It shows basically that these people's money is lasting until 93, which is obviously very long time past what would be for most people their statistical life expectancy. And then this graph is looking at cash flow or your income. So the previous graph was looking at how much assets you've got and how long they last. But it's possible to be, as they say, asset rich and income poor. In other words, not being able to generate enough income from your assets. In this particular case, what the output of this graph is trying to show you is that there's a red line at the top of the graph. Now that is the 60,000 these people need to live on, and below it is, in this example, there's a purple color and a blue colored bars. They are sources of income. Now the purple is account-based pensions, or allocated pensions, as some people call them. You've turned your super money into a pension, like we've been talking about tonight. So money is being drawn from there. But the other, the blue, which is down the bottom of the chart, that's actually income support, or in this case, it's the age pension. And so you can see that this particular couple are being supported quite strongly over a long period of time through the government and the age pension. And this is actually very surprising for a lot of clients who didn't actually realise the long-term impact that the age pension can actually have on their retirement funding. It does show, just to explain the graph a little bit further, it does show that in age 93, you can see the income bars don't meet the red line. That's the point. As we saw on the previous graph, where basically their funding has run out, and they are basically starting to be reliant on just the age pension. But they have reached 93, 94 years old by that stage.
Thank you, Phil. And just to move to age pension, as you can see how critically important it is for most, and it should be noted that around 4 out of 5 Australians get some form of age pension. So not the full age pension, but some form of, so at least a partial payment. In terms of eligibility for the age pension, we talk about the age criteria, we talk about needing to be an Australian resident, and also the 2 tests, the assets test and the incomes test, and we will look at those now. When we talk about eligibility, you'll have noticed that the age has increased, and as you can see there, it's moving to 67, largely as a reflection of Australians' increasing life expectancy. Our life expectancy in Australia just is relentlessly going up and up and up, and the age pension eligibility start date is reflecting that, if you like. So as you can see there, if you're born on or after 1 Jan 57, it's 67 years. If we have a look at a single person, you can see there, to get full pension, they would need to have less than $270,000, $500 in assets. And for a non-homeowner single, they would need to have under $487,000. Now, the next obvious question is, what does this include? It includes everything other than the home. So please think of it as all assets, including superannuation. The only asset excluded is the owner-occupied dwelling, if you like, so the home that you're actually living in. And again, you can see there, for a single, once they have, as a homeowner, 593,000 or more, or as a non-homeowner, 809,500, they're no longer eligible for age pension. The thinking being they've got sufficient assets to be able to fund themselves. If we have a look at the more typical scenario, which is the couple homeowner, you can see there, a couple homeowner can have up to 891,500 and still get some form of age pension under the assets test. So they would need to exceed that to be excluded from the asset, to be excluded from age pension under the asset test. And for the non-homeowner, you can see it's a more generous number because they've obviously got rent to pay. So again, I would argue those limits are pretty generous. Also on the income test, you can see there. Actually, Phil, do you want to speak to the income test? I should just say before you do, consider the government takes into account the test that will minimise the age pension payment. That is, they will take the test that minimises the age pension payment you are eligible for, if you like. So it doesn't use the test that provides the best outcome for you. They use the test that provides the best outcome for taxpayer money, if you like. Phil, if I can just ask you to talk through the income test, if you would.
Yeah, sure. So Centrelink, generally speaking, work on a fortnightly basis, and that's why the figures here are quoted as fortnightly amounts. So basically, a single person, if your income is less than $180 per fortnight, then under the incomes test would be eligible for the full age pension. But if your income is over $2,115 per fortnight, then you would fail the income test. And like Wayne said, what Centrelink do with the means testing is that if you've got two tests, if you fail one of them, you're out. It doesn't matter whether you pass the asset test or not. If you fail either the asset or the income test, you won't receive anything. A couple corresponding figures. If you're earning less than $320 per fortnight, then under the income test, you'd receive the full age pension. And if you are earning more than $3,237 per fortnight, under the income test, you wouldn't receive any age pension.
Thank you, Phil. And just to show you what is possible, as you can see there, the maximum you would receive as a single, the maximum you would receive each and as a couple, and a couple living apart, actually, which is happening increasingly due to an aging population and people's ill health in those older years. You actually receive the single rate each, if that makes sense. The other thing to consider, and Phil, you would get this question all the time, because at seminars people ask this all the time: will I be eligible for the seniors health card? As a rule, yes. If you're on age pension, you will be eligible for the seniors health card. So there are some residency rules. It does afford you cheaper medicine and bulk bill doctors. Remember, this is a federal card. So because it's within the purview of the federal government, it applies to things that are dealt with at a national level rather than a state level. Phil, is there anything to add to that when you're explaining the Commonwealth healthcare card?
Just a little bit. I mean, this particular card is talking about the Commonwealth Seniors Health Card. The age pensioners receive the pension card, which does provide them with healthcare benefits. The Commonwealth Seniors Health Card is actually can be received potentially by people who aren't eligible for the age pension, but have met the age requirements for the age pension. The thing with the Commonwealth Seniors Health Card is there's no asset tests. So with the age pension, we just talked about the fact that there's an asset test. There's no asset test for the Commonwealth Seniors Health Card, and it also even the income test itself tends to be a bit more generous or lenient. You can see, I mean, there's a couple there, $92,000 odd you can earn as a couple before you don't receive that card. And it's also different to the age pension means test in the sense that it's not like one of these shade out tests like the age pension is, like a sliding scale where your income goes up and you get proportionally less. The means testing of the Commonwealth Seniors Health Card is that if you're under 92,416 for a couple, you get the card. That's so yes. So I think the answer is that yes, a lot of people are are eligible for it. Because of that fact, the means testing is probably a bit more lenient or easier to get.
Thanks, Phil. And also there's the state and territory cards, which will obviously differ, but these apply to often utilities and public transport because they're dealt with at a state level. Phil, can you speak to the New South Wales one at least a little bit?
Yeah, I mean, I think you've got to be 62 or 63 years old. You get discounts on public transport and things like that. So I think you must be working. I think it's less than 20 hours per week. So you don't have to be fully retired. Yeah, I mean, you say each state government offers slightly different variations of this type of benefit, which is once again is definitely worth pursuing.
Thank you. We do need to talk about aged care because increasingly we've spoken about super, we've spoken about those going into the pension stage, but increasingly aged care is becoming a critical topic for more and more people as life expectancy goes up and up and up. End of life sort of conversations are becoming more and more common, and it's worth the membership understanding that we are able to assist with regard to the financials and helping people understand and advise around the financials with aged care. We certainly can't choose a facility for you, but we can help with the modelling of the costs around it. And, Phil and those in financial planning can also help to budget for what could be a large expense late in your retirement years, if you like. So it's an important one. It often involves more than just the member for obvious reasons. It involves the family. And increasingly, it's becoming a discussion that's needed, and it's becoming a discussion that can be difficult for obvious reasons. Phil, do you just want to touch on that a little bit with some of the discussions you would have had today?
I think the vast majority of people that we actually see aren't seeking aged care for themselves. The issue is with their parents, and so a lot of the discussions we're having about this type of thing are about how are the clients that I've got in front of me, are they expecting to need to help fund this type of arrangement once again, or they're helping having to help their parents in this area because it's complicated, and as you say, so there's a lot of money involved. So yes, we don't get involved in actually helping to choose the aged care facility, but we can do some scenarios on what might be the financial consequences of some of the options that are being looked at.
Thank you. And lastly, if we think about the stages of life, we get to estate planning. Critically important again, and we would encourage anyone who has a superannuation fund to update and ensure they have their beneficiaries named. Again, very, very important. And for those who don't have a will, quite obviously and quite frankly, you should have a will. We still see people dying in intestate, which means essentially they don't have a will. But ideally, people would have a will, and they would also have attached to it a power of attorney and perhaps even an enduring power of attorney. So when they're unable to make decisions, there is a power of attorney arrangement that can assist there. Phil, do you just want to touch on some of the discussions you would have with members about what can be an uncomfortable topic?
Yeah, so there's talking about these sorts of things is, obviously all linked in with the other parts of our discussion, because it's another stage of life. We we're not solicitors, so we're not, we don't provide personal advice in relation to wills and power of attorney, but we work with solicitors or legal professionals, or we refer in those sort of cases about, well, just making sure that people are dealing with, a professional in that area to get the right advice. As far as beneficiaries are concerned, yes, I echo your comments that it's important to make sure that you've got, I guess, that you feel confident that your money is going to pass where you want it to go when you retire. With superannuation, there's a range of different, there's a few different types of nominations that can be done, and we talk to the clients about some of the merits of the different types of nomination and how they might apply in their particular circumstances, making sure that they're that some of them expire, making sure people understand that these things sometimes can expire. So so having those sort of discussions is it's very important.
I'm going to say, and this leads us obviously, Phil, to how planners can assist people. As you can see there, and as you have got, and as you would have learnt throughout this session, financial planners can assist in many, many ways. And these are the things Phil and his team do all the time to help people with Centrelink to navigate through what can be very, very confusing, to talk about longevity risk, to help ensure money will last throughout retirement, to map out people's goals to ensure there's sufficient money to meet them, to assist with estate planning that we've just spoken of, and also to advise on those non-super investments. So these could be, as mentioned earlier, these could be shareholdings, they could even be investments that tie up a lot of capital that don't necessarily produce an income. And I'm thinking about, for example, classic cars or artwork or something like that, which may need to be monetarized, if you like, in order to get an income stream from it. Phil, do you just want to talk to how else planners can assist people?
Yeah, I mean, just on that point you were talking about, I mean, the most common sort of scenario is, generally speaking, is people have either got money in the bank or they're about to have money in the bank because, as you say, they've liquidated an asset, they've sold a property, or or a car or something like that, but they may not be able to contribute the money into super because for various reasons, because of age, because of there's limits, as we've been discussing today. So there's a variety of reasons that people may not be able to contribute to super. And what a lot of people are actually surprised to learn when they're dealing with planners at Australian Catholic Super is that we can assist in a lot of cases here as well, even though the recommendations may not be to contribute into superannuation. I mean, a lot of the common things, quite common in what we recommend, are things like investment portfolios and managed funds. And we just take clients through these things and provide some education and try to explain the risks and benefits of some of the various strategies, so that quite often people are quite surprised.
And there's also the two common ways that people benefit from advice. There's obviously the tangibles. So the financial stuff is, in some ways, is quite easy. You can see the benefits, whether it be in increased Centrelink payments, whether it be in consolidating assets or whatever it may be. But it is often this intangible stuff that matters the most. And that is, you've relieved me of the anxiety of finances in retirement. You've empowered me in a sense, because I now no longer have to be overly concerned about it. I know now how easily I can adjust it. I understand I can come to you if I need any further help. And it's just another worry I don't have at a time when, frankly, I don't need any more worries, if you like. Phil, you could no doubt put that better than I. But.
No, not really. I think that's totally right. I mean, I think right at the moment, I'm working with a couple of clients that you know, just I think the intangible is the point I'd like to make. Just not knowing and not having the time, you know, that's not their area. About understand, you know, to be able to understand what their financial situation is. They just are getting. I think they're seeking peace of mind in. Well, not just peace of mind. Even it's knowing where they stand. They've got this feeling that I actually don't know. When can I afford to retire? I think this is what I'd like to. This is how much money I think I'd like to be able to have as an income in retirement, but I don't know whether I can afford it. We're trying to give you some answers to those questions, and if you can't achieve what you hoping to achieve, we want to talk to you some more about, you know, how we can help you with that, or how maybe you could adjust those plans to try to come up with a solution.
Just with regard to the advice offerings, just if I can just emphasise the point, you can get general advice whenever you wish. You can get help over the phone, or you can get an individualised, comprehensive financial plan. Now, it should be understood that the fees paid within the superannuation fund are able to provide you and ensure that we're able to provide that general advice and that over the phone service. However, if you do want an individual comprehensive plan that covers all aspects of your finances, there would be an additional charge on that. But again, that would be a discussion you would have typically with a financial planner. When you see a financial planner, understand there's no cost or obligations for the first meeting. So it's a discussion usually around, can I help? And there are occasions where quite honestly, Phil may say, look, I don't think I can assist you a lot. So I think you can navigate this on your own. Or the member will say, I really need this sorted out. Can you give me an understanding of what it would cost in terms of time and money to put together a financial plan? Phil, typical costs around a comprehensive financial plan, because people may obviously be concerned about that.
Yeah, ranges. I mean, probably, I don't know, ranges anyway. In my experience, anywhere between about $500 to $3,500. Like you said, I mean, it's related basically to, you know, the complexity and how much work is involved. We're writing a plan for a single person or a couple, you know. So, you know, it just depends on the circumstances. We quote every job individually. Yes, that's the sort of broad range that it generally costs.
Thank you. I do too, before we finish up, I do want to touch on Lifetime One, because this is our default option. And Lifetime One's quite unique in the sense that it becomes more conservative as you get older. So it is one of those portfolios that is dynamically managed. But if we have a look, for example, in the financial year gone by, you can see that for a 40-year-old, it had an earn of 20.9%. And if you have a look at the other age brackets, you can see the returns there. By historical standards, very strong. But you can also see very clearly that for the older brackets, it is managed more conservatively. And hence, that's why you do have that lower return, because it's guarding you against volatility, particularly downward volatility. So it's performing, as you can see there, as you would expect it to. So for those that are interested in more detail around Lifetime One and its returns, we would obviously direct you to the website. To recap on what I started with when I mentioned the merger discussions going on, please understand that the trustee will always act in the beneficial interests of the member, and that is its primary purpose. So please feel free to get in touch with anyone if you have any concerns about the management of the fund. And again, if you had any other super fund outside of Australian Catholic Super, the trustee would act the same way. So you are empowered to find out exactly how the fund is ran, what the costs are, and how it's performing. As I say, funds disclose pretty much everything on their website, and equally we do too. And this is where I would encourage people to be registered for the member portal. A lot of the things we've covered tonight are available on the member portal, but if you want specifics around your own holding, you will need to log in. And this is where you can do a whole load of transactions if you like, and you can get a lot of detailed information, some of which includes the following. You'll be able to find out, obviously, your balance and the makeup of the fund. You can change the investment option. You can make an additional contribution, work out the insurance you have. You can update your beneficiaries and many, many other things. The other thing I need to mention too is there's a phone app as well. So for those that want to be able to see the value of the fund and the characteristics of what they've got with Australian Catholic Super, it is literally just a couple of taps on the phone, and you'll be able to get all the information you need and the contact details for us if you wish to get in touch with us. It will provide these details to you, but feel free to make a note of these. We're now at the stage where I just want to circle back to Justin just to see what's come through on the chat room and if there are any outstanding topics that either Phil or myself should cover. Justin, over to you.
Thanks, Wayne. I think you and Phil have covered all the topics today. We've only had some minor questions and clarifications on what you've spoken about today, which I've been able to answer online to the members. So there's nothing really that I need you to go back on and touch on again. So I'll leave it to you guys to wrap up. So thank you. Excellent.
Thanks, Justin. Well, once again, thank you to everyone who attended today. As I say, this is the last webinar of 2021. Thank you, Phil. We do really look forward to speaking to you in person in 2022 because it's been a long time that we've been conducting everything via the laptop, and to do things face to face will be wonderful. So if you don't hear from me or any members of the fund before next year, have a truly fantastic Christmas, a wonderful new year, and we look forward to being in touch next year. So have a wonderful evening and good night.
Thank you.